it does seem like analysts were noting that the pricing during the quarter was weaker than expected and marks the second straight quarter of softer pricing. And maybe that's why we're seeing the stock down. What do you want to say to investors?
Well, part of the reason our stock's down is it's priced to perfection. If you look at what it's done, year to date and where the multiple has gone. But, we had a really good quarter. We had a double-digit quarter. We hadn't seen that for a couple of years. Double-digit growth, sorry. And pleased with the outcome. One of the challenges we had this year was there's a lot of fluidity around tariffs and what it means for pricing. And we will raise price to address costs in our customer supply chain. We really don't want to raise more than that because we believe it impairs our ability to grow as fast as we'd like. And coming into the quarter, we estimated X for impact of pricing, came in a little bit less. We lowered our number for the fourth quarter. But the most important aspect is on a price cost basis, we are neutral. And that's what we aspire to be. We'd rather just grow.
Mm. And Dan, to your point, Fastenal, even with the pullback today, returning 22% year to date, so outperforming the S&P 500 and comparable stocks in the industrial space. But just one more question on pricing in terms of expectations. Would you want to raise pricing? Like, do you get the sense that consumers and customers would push back, just given how you've been shifting into bigger customers spending much more money?
Yeah, customers always push back on pricing. Doesn't matter the size customer. We are having conversations with our customer. We will be doing some price increases in Q4. I suspect we'll be doing some price increases as we move into 2026. But again, our first discussion with the customer, they understand it. They're willing to move on price. Our first discussion is always, what are alternatives to this product that maybe doesn't mean we have to raise your prices 5%. Maybe it means it only has to be 2%, and we'd rather go to 2% because that's what a supply chain partner does.
Well, Dan, how do tariffs fit into this? Just given that, according to analysts across the street, when we look at certain industries, now is when we're going to see tariffs showing up in the third quarter in guidance as it relates to 2026. What are you seeing, and how are you kind of attacking or addressing any pressures from tariffs?
Yeah, so for us, tariffs have been in the equation since the early part of the second quarter, a little bit of the first quarter. I think in the individual that handles pricing, historically he'll provide us an update once a month. He'd gotten to the point where he was not only providing us updates, he was up to video number 14 as of July that he was serving out to the field, giving them guidance into what we were seeing in our supply chain. And so we've been adding price as we've gone through the year, and these have been discussions with customers. And I hope that answers your question.
No, I think it does. But I think the big thing is, are you mitigating the impact of tariffs? Are you shifting your supply chain? Is the expectation that you can have some kind of knock-on effect as it relates to pricing if we do continue to see threats from the president going after countries like China or others? We are going to talk to one of the members of Levi's management team, and they called out that they had to dial up their expectations for the impact of tariffs from other countries. So how is that impacting when you look at your supply chain and when you look at the potential for pricing impacts in 2026?
We've been moving supply chain around the planet in earnest since 2017, 2018 timeframe. As our name would imply, we sell a lot of fasteners. And most of the fasteners in North America come from either mainland China or Taiwan. And the automotive industry took the production there back in the 50s and 60s, actually took it to Japan and South Korea, and it migrated from there. If I look at our resources, we now have a sourcing team in Shanghai, but we have a sourcing team in Bangkok. We have a sourcing team in Northern India, and we have worked to diversify our supplier base around the planet and a little bit more in North America, but really around the planet. So to have diversity in supply, so you're not caught off guard by some price change or a tariff change. In addition to that, we've taken supply chains coming in North America, which traditionally came in through the West Coast of the United States, and then we would redistribute from there. We have moved supply chains so they're bringing product directly into the West Coast of Canada, or the west coast of Mexico, because those two countries represent about 14% of our revenue. Now, you bypass the tariff. However, it's more expensive to break shipments down over in Asia and bring them in, but it's a lot less than a tariff.